the market return in it, you get the small cap premium in it, and you get the value premium all wrapped up in one. You don't get the value premium in the S&P 500 in the same way. You don't get the small cap premium in the S&P 500. Let's just look. Instead of 1 year at a time, let's look at 10 years. Looking at the decades from 1930 to 39, 1940 to 49, 50 to 59, etc. And we can see in each decade which of these asset classes, by the way, in this particular study, Daryl was kind enough to add fixed income. So you could get an idea that for young people who think that fixed income is a good thing to do, that for the long term, it probably is not. And these are nominal returns again. Daryl's always there to make that difference, not inflation adjusted. Look at their small cap value at the top by significant amounts, by the way, in 5 of the 9 decades. But there are a couple of decades the S&P 500 was at the top. There was also a decade that it was at the bottom, another decade it was at second from the bottom. In fact, T-bills from 1970 to 1979 had a better compound rate of return than the S&P 500. And over the whole period, small cap value 13.7, S&P 500 9.8, 1930 through 2019. But I want you to notice again about that 4-fund strategy. I think this is important. The 4-fund combo outperformed significantly in many of the decades the S&P 500. I'm here at 1940 to 1949, 14.3 for the 4 funds versus 9.2. 1960 to 69, 11.3 versus 7.8. 70 to 79, 10.6 versus 5.9. Yes, in 1990 to 99, it was number 1. And in 2010 through 2019, it was number 1. But look where 4-fund combo is. It was just right in there, just almost, not quite the same, but almost the same. So when somebody says, put all your money in the total market index, or put all your money in the S&P 500, I just want you to see there are other things you might do if the future looks like the past. And when you do it, you are increasing your diversification, not only with more companies, but with more asset classes. And then Daryl did something, this is just a part of the entire study, but it's kind of the bottom line. And I love this study too, because it tells us in a way what we might expect depending on how radical a position that we take. It turns out if we take the position that the S&P 500 is a place to be, that in 36 of these years, that you would be in the top 20%. And in 48 of the years, you'd be in the bottom 20%. Interestingly enough, with very few in the center. At the other end of the spectrum is the small cap value, 45 times number 1, 31 times number 5. As opposed to what? As opposed to a portfolio that's all value, small and large. You didn't get 13.4, but you got 12.5. That's pretty doggone good. Or the 2-fund strategy, the S&P 500 with small cap value, 12.2, 2% better. There, you were never in the top quintile. You were never in the bottom. You were always somewhere in the middle. And then the 4-fund strategy made a little less, 12% instead of 10.2. Again, rarely at the top or the bottom. And then finally, the S&P 500. Now, I'm rooting for people. I get paid nothing to do the work that I'm doing. In fact, I'm the one that has written most of the checks to keep this process going. I am trying to change the financial future. Now, so many of you, you're in your 40s, your 50s, and your 60s, and you're going to say, well, that's interesting, but I've already got a portfolio that I know enough about that I don't need to improve mine. But I am hoping that you'll suggest to your kids that maybe this is a better idea than what you've been doing. Maybe. And by the way, this is not me with a big know-it-all head. In fact, just the opposite. I can't know it all. In fact, I know what people want to know. I've been in the business. I was in it from 1983 and until 2012. People, the most asked question is, what do you think the market's going to do? And if I answer, how the hell should I know? They think, well, I don't want to do business with you. I want to do business with people who know what the market's going to do. Well, most bogleheads and most members of the AAII, where I've been teaching since 1983 or 4, they know better. But we're all longing for someone to know. I think what you can know kind of how the volatility is going, what's going to look like. Not when is it going to be up 20 and down 20, but what should I expect in terms of down years and up years? And how long may a bad period go? There are a lot of questions that can get answered from looking at the past. That's the part of the past I want you to know. But it was the academics who noted the small cap and the value factor, premium. And you can choose to say, there is no premium for small cap. There is no premium for value. Or you could say, by the way, you could, because nobody knows, there also is no premium for stocks over bonds. Well, in fact, since the year 2000, that's been largely true. Yeah, I mentioned earlier, for 25 years, the market was up over 17% a year. But since it was up over 17% a year for 25 years, since 2000, the compound rate of return is less than 7.5% for the S&P 500. Is it reasonable to conclude that the premiums that we've known in the past from equities are gone? I don't know. Nobody knows. I don't think so. Lesson 7, why most people who try small cap value will be disappointed. There are people who should never touch small cap value, because the moment that they're going to want to touch it is when it's red hot. And that's when we get burned, right? Let me show it to you. This is thanks to Daryl Balls again. This is called a telltale chart. The best of our knowledge, it was the first telltale chart was developed or what was displayed by John Bogle, but we don't know that for a fact. But here's what it shows, and it's magic in the story it tells. It compares the relative growth of two asset classes. In this particular case, small cap value and the S&P 500. When the line is going down, when the graph is going down, it doesn't mean that they're losing money. It means that the relative growth for the S&P 500 is better than that for small cap value. When the lines are going up, it means small cap value has better relative growth. Now, if all I want to see is the bottom line, I go to the far right over here and I look at this 14 number, and it says basically if you put money into small cap value back in 1927, you would end the period with 14 times more money in small cap value than you had in the S&P 500. Oh, well, I want some of that, of course. But you have to understand that for about 17 years and 6 months from the beginning time in 1927 until sometime in the 40s, you would have been better off to be in large cap blend in the S&P 500. But small cap value finally caught up and did better, only to move sideways for another 19 years. Then it spurred up again for a very short period of time, and then it moved sideways for 7 years, 11 months. Then another spurt and another sideways for 17 years. Then another spurt, then another sideways for over 16 years. And what do you think? When do you think that investors are going to be most interested in adding small cap value to their portfolio? You see, this is why I want you to think like an advisor. I want you to know what an advisor knows about these numbers. Because when you get tempted by the emotion of investing, you see, that's why people theoretically come out ahead with a professional investment advisor, financial planner, than doing it themselves, because they're supposed to be objective, one, and two, they're supposed to be educated. And this is the information they're supposed to know. That they can say to you, wait a minute, I just want you to realize you're wanting to add an asset class that has been making tons of money at a time that maybe it's not going to make tons of money for many years. By the way, for those very long periods where it moves sideways, at the end of that period, it means basically that the S&P 500 and small cap value ended at the same place. Thank you, Daryl Balls. Lesson number 8. Few funds, a couple of funds, 3 funds, 4 funds, maybe 5 funds can be just as profitable as having 10 funds and without taking any more risk. Now, this was a lesson that changed my life, because I was out there telling people about the strategy that I was using for my clients, not thinking about the implications of people being a do-it-yourself investor. So here was the pitch I used to make. And we updated this table every year. The pitch I used to make was, you put $100,000 into the S&P 500 in 1970. How would you have done if you just let it be? You didn't add any money, you didn't take any money out. Without paying any taxes, an 11% compound rate of return grew to $23 million. 100,000 to 23 million. That's all you need to know. But if I made one very small step, a baby step, and I added large cap value as an asset class for 10% of the portfolio, the return goes up from 11 to 11.2. And you may be saying, well, so what? I mean, that's not all that much. Yes, it is. The 23 million goes to 25 million. And then when you add 10% small cap blend, and it goes up 1/10 of 1% more, it adds over another about 1.7 million. And then you add small cap value, and it goes up about 5 million. And by the time you've added REITs and the international asset classes, big, small, value, etc., and then you add also emerging markets, you have gone from an 11% compound rate of return to 12.6. And you're more diversified. You're a little more volatile, but most of that volatility, as you're going to see, is on the upside, not on the downside. But I tried to take this 10-fund strategy and shove it down the throat of do-it-yourself investors. And that's when I got the what for from John Bogle, when I spent 90 minutes with him in 2017 in his office. He was the best teacher in that 90 minutes I ever had. He not only changed my life, and by the way, Chris Pedersen was trying to get me to do the same thing, but he changed the life of a lot of people who are now willing to do something more than the total market or the S&P 500. Maybe not with much, maybe just with a little, but give themselves an opportunity to make a better rate of return. Another lesson on this page, by the way, I want you to look down here. Notice instead of 12.6, this particular same, by the way, same asset classes, 0.3% less. Instead of 47.7 million, you end up with 42.6 million. The difference is the portfolio was rebalanced on a monthly basis instead of an annual basis. The top one is annual, the lower one is monthly. But it's less risky because you keep taking money away from the more risky asset classes that are producing the higher return. Daryl is working on a wonderful study right now. The implications of rebalancing every couple of years, every 3 years, every 5 years. I think you'll like it. So out of this came, between John Bogle's motivation and Chris's willingness, along with Daryl Ball's, to work hard to help us see what these small portfolios, what they could do. We developed all these different portfolios, and now what we need to do is to be able to show people how, with a few funds, we're still getting access to value. We're still getting access to small. We're not ignoring those things that we want in that portfolio. And once again, Daryl Balls hits a home run. I'm not kidding. The first time I saw this table, and I love tables of numbers, and saw what Daryl did in trying to help people, to educate people, I was just blown away, because I now understood risk from a whole new way. Here's what he did. He took each one of these portfolios, the S&P 500, the 10 fund strategy, the 4 fund worldwide, the 4 fund US, the 5 fund worldwide all value, the 2 fund all value US, the worldwide 2 fund small cap value, that could actually be 3, and the combination of the US large blend and small value. And there's one more here. No, there's the all small cap value, and the last one here is the US 2 fund, half S&P 500, half small cap value. And here's what he did. He created, and he sent this to me with these boxes, because he knew it would help me, and I hope it helps you. Because one way to look at return is to break this down over some periods of time that would be meaningful, to see how different they might be for what we'll call a relatively short period of time. In this particular case, he looked at 10-year periods. He looked at the S&P 500, looked at the whole period from 70 to 21, got an 11% compound rate of return, but he looked at 70 to 79 and 80 to 89 and 90 to 99, 2000, 2009, and 2010 to 21, just to catch what we had. And the first thing that just stood right out to me was not only the difference between 11 and these other compound rates of return, but 70 to 79. Here is this problem of owning one asset class. It wasn't good during that period. And yet the worldwide all value, or the US 4 fund strategy, or the worldwide all small cap value, they were clear winners during a period of time that people thought it was the end of the stock market, literally. The end of equities was the front cover of US, I think it was US News and World Report. But, and by the way, the same thing happened in 2000 through 2009. The S&P 500 had a terrible 10-year period, but everybody else, all these other combinations, because they were other asset classes, in many cases, along with the S&P 500. So I thought the blue area was really helpful in understanding the kind of randomness of this, how different these different strategies might perform. I thought maybe people might start thinking about, well, maybe I'll have some of the 4 fund US and the worldwide all value. I mean, I didn't know how people might use this information. But then Daryl did a second thing. He looked at only the up years. So he looked at the S&P 500 and each of the other, and he looked at how many years, pardon me, were they up? They were up in 42 years out of the 52. And the average gain was 18.7%. That's an important number. The sum of all of those years was 787% when they made money. And the best year was up 37.5. Now I can look at other strategies. And the first thing I noticed is in every case, the averages were much, much higher. Well, I guess we should have, because the returns were higher. But in some cases, by a lot. But that tells us about the good times. And nobody has any trouble with the good times. In fact, I would bet that if somebody owned the S&P 500 and they were up 18.7% a year average on those 42 up years, they would be pleased as punch, okay? But it's the down years that causes people to leave the industry, to give up on their investing, which is that reason I'm so pro for-fund strategy, to try to protect from things getting too far out of whack. Well, here's what we know. If you looked at all of the down years, you would see the sum of all of the 10 down years with the S&P 500 was 141%. Well, that's a nice relationship. 10 losing years, 141%, 42 profitable years, 787. The gains are 18.7, the losses are 14.1. You know, I've got a feeling for that asset class and that strategy. On the other hand, just for fun, go all the way to the right side of the page and you'll see the number of up years, 41, for the two-fund strategy that is half S&P 500 and half small cap value. Total sum of the bad years, 130% versus 141 for the S&P 500. Whoa. I mean, the part I don't like is losing money. And that tells me that it is not unreasonable to believe that the losses that I will sustain in the future will be similar, whether I am in the two-fund strategy or the S&P 500 alone, but one gets 11% and the other gets 12.7%, at least during this period of time. And here's the other part that we should understand. If the down years are about the same, but if the standard deviation for that two-fund strategy is higher than the standard deviation for the S&P 500, people are thinking, oh, it's more risky. Well, in a sense, it was more volatile, but it was more volatile in the good years. It was the good years that made the difference in that standard deviation, not the bad years. I love this work, Daryl. Thank you. I know I'm running out of time. I'm going to keep going here. I'm going to make this one real short. Lesson number 9. The Bogleheads in Boston already heard from Chris Pedersen. He developed a strategy called Two Funds for Life. It is one of the most clever strategies I have ever seen. What he did was he combined a target date fund, a fund that changes its asset class, its mix as you get older. It starts adding more fixed income to the portfolio, as you would expect a pension fund who was taking care of your pension payout would get more conservative as you get older. But he adds a little something that just isn't there in that target date fund. He adds small cap value, and he's got a couple of ways to add it. One is you just put 10%. Let's say you're investing 10% of your money. 9% goes into the target date fund. 1% goes into the small cap value. And over a period of investing, you will probably pick up an extra 0.5% return over time. And if you put in 20% instead of 10, you even make more from everything we know about the past. And you would be making a weak fund stronger. I love target date funds. I am not being critical of them. But for reasons of not wanting to deal with questions from investors, why is this in there? It didn't do well last year. They don't put small cap value into the fund for any significant amount. And by the way, Chris then came up with another super idea, and that is for people who are young and more aggressive. And by the way, the last half of We're Talking Millions is dedicated to this particular strategy in a really basic way. In Chris's book, Two Funds for Life, he digs in like a good engineer would and really tears the strategy apart for people who are really interested. It's a wonderful book. It's the only one of our books that aren't free, but I can tell you that every book that's sold at Amazon, the royalties all go to the foundation. Chris does not get a cent. You multiply your age times 1.5. You're 30, that'd be 45. 45% goes into the target date fund. 55% goes into small cap value. As you get closer and closer to age 60 and 65, you are in the process of eliminating the small cap value. And if you really want to spend the time, go watch his presentation to Bogleheads, the Boston chapter, that was done earlier this year. And in, I think, the chat notes, you all have access to a PDF. So if you want to capture these links, all you have to do is download that PDF, and it will give you all the links I'm going to mention as we go along. How much in stocks and bonds? Huge. This is a huge decision. I want you to be all in stocks when you're 20 and 30. I want you to be all in stocks probably till you're 40, and then start cooling your jets a little bit. But here's what we provide. And I know this looks like a lot of numbers, but that's what an investment advisor wants to see. They learn from these numbers. And by the way, the numbers are way better than a graph, because the graph hides a lot of stuff that you can see when you see the numbers. But we have fine-tuning tables for every one of our strategies, equity strategies, combinations of those different equity asset classes. And on the right-hand side of this table is the 100% equity portfolio. So you can look year by year from 1970 through 2021 and see how the S&P 500 did. And we loaded it with a minimal expense that you would pay today. On the far left-hand side is 100% bonds. And as you move to the right from the left, every time you move one line, you are adding 10% equities. So those of you who are afraid of equities, I want you to see the bottom of this page. This is where the learning is really good, I think. I want you to notice 100% bonds over that 52-year period had a 7.1% compound rate of return. That's probably too high, isn't it, today? By a lot. Maybe not for long, we don't know. I want you to see what happens. Every time you add 10% in stocks, the return goes up. 0.5%, 0.5%, 0.4%, 0.5%, 0.4, 0.3, etc. And every time you add more equities, not only does the return go up, but so does the risk. So my wife and I, we are not in the fine S&P 500. We're in the 10 fund strategy. But with the S&P 500, if you have a 50-50 stock bond portfolio, you got to be ready to lose 23% of your money in a year. Well, I mean, you do if you think the past is relevant. And I love to be able to show these negative numbers to go along with the positive numbers. You see, when you get a sales pitch and not a real advisor, You'll be learning about the upside. You will not be learning about the downside. And I want you to prepare, hope for the best, of course, but prepare for the worst. Make sure, in some cases, it makes sense for people to take less risk and save more money. Because if they take too much risk, they're gonna throw in the towel, and then where are they? And I have, like I said, I got these same tables. Daryl puts them together. This table's for the US 4 fund portfolio. You can see the exact same relationship between return and risk, except that as you move across the table, you're picking up more than 0.5% because the underlying strategy had a higher compound rate of return. 11, young investors, please share this with them. Another one of Daryl's goodies. I told him I wanted to figure out a way to help young people understand what it's like to put a little bit of money in and keep adding some money. And he came back with this, and I love it. You take the strategy. We do this again with all the different strategies. Some of them, by the way, are 50-50 US international. Some of them are 70-30. I mean, we look at it from every direction or many directions. Here's what happened. You put away $1,000, $83.33 a month. At the end of the first year, after taking the risk of the stock market, you had $1,022. In other words, you put in $1,000 of your money and all you got was $22 lousy in profit. And you could say, what is going on here? I did this to make money. Well, you see, when you see the rest of the table and you understand what patience, and maybe these tables help build patience, and that is always what an advisor is trying to do, is to build patience with the investor. Notice what it looks like at the end of 10 years, 16,000. At the end of the next 10 years, almost 120,000. At the end of the next 10 years, almost $700,000 after 30 years of putting away from $1,000 to $2,300. And then the worst thing happened for the next 10 years. Remember, this is the S&P 500 only, no asset class diversification. The next 10 years ends with 662,853. You lost money overall. But what if? What if instead you had the US 4 fund strategy? Remember, it's a big, small value, growth, etc. Where were you at the end of 30 years? Well, you were a little over 700,000 at 783. Maybe not as much over as you thought you would be, but at the end of the next 10 years, instead of losing money, you had 1,282,000.